In the 6 days following October 24, 1929, $30 billion were wiped out, the equivalent of $500 billion today, gone. And here's the crazy part, every warning sign was there. Experts were screaming danger. The data was shouting get out now, but nobody listened. Today, I'm going to show you how mass psychology can turn smart people into blind gamblers, and why this story keeps repeating itself over and over again. But first, let's go back to 1928. America is euphoric. Imagine a world where anyone can get rich. Your taxi driver is giving you stock tips. Your barber tripled his money in 6 months. Your 65-year-old neighbor is buying stocks on margin because everyone's doing it. This was America in 1928-1929. The Dow Jones had climbed 400% in less than 9 years. Radio Corporation of America went from $85 to $420 in a single year. People were mortgaging their homes to buy more stocks, and the financial system made it easy for them. Here's how it worked. You could buy stocks by paying only 10% of their actual value. The remaining 90% borrowed from the bank. That's called buying on margin. If the stock went up, you made a fortune. If it went down, well, nobody thought it could go down. And guess what? Absolutely everyone thought prices would keep rising forever. But there was a problem, a big problem that almost nobody wanted to see. I'll come back to that in a minute. As early as 1928, voices started to rise. Roger Babson, a respected financial analyst, gave a speech at the National Business Conference in September 1929. He said, word for word, sooner or later, a crash is coming, and it will be terrible. The market dropped 3% that day. They call it the Babson break. But you know what happened next. The market recovered completely within days, and Babson became the laughingstock of Wall Street. The press ridiculed him. Investors mocked him. Why? Because up until then, every correction had been followed by an even stronger rebound. That same month, Paul Warburg, one of the founders of the Federal Reserve, published a warning. If speculative excesses continue, the ultimate collapse will affect the entire country. Public reaction. They accused him of being a pessimist trying to drive the market down so he could buy cheaper. Listen to this. In September 1929, the price-to-earnings ratio of stocks was at 32. Today, anything above 20 is considered dangerous. At 32, that's pure madness. But here's what's fascinating. Investors aren't stupid. They see the numbers. They hear the warnings. So why do they keep going? Psychology gives us 3 answers. First reason, recency bias. For 9 years, buying stocks had been the smartest decision you could make. Your brain tells you, what happened recently will continue. It's a mental shortcut that served us well for millions of years of evolution, but becomes dangerous in finance. Second reason, social proof. When everyone around you is getting rich, and you're not participating, you feel stupid. FOMO, the fear of missing out, is one of the most powerful psychological drivers that exists. In 1929, not being in the market was like being the only one without a smartphone in 2025. Third reason, rationalization. Economists at the time had brilliant explanations to justify the prices. New economic era, revolutionary productivity. The fundamentals have changed. Sound familiar? Crypto in 2021. .com in 2000. Same logic. Let's get back to our story. We're in early October 1929. On October 3rd, the market reaches its all-time high. The Dow Jones is at 381 points. Newspaper's headline, Permanent Prosperity. On October 19th, the market starts to wobble. Nothing dramatic, just the hesitation. On October 23rd, things accelerate. Trading volume explodes. People start selling massively. And then comes Thursday, October 24th, 1929. Black Thursday. At the opening, it's total chaos. Sell orders overwhelm the system. The ticker tapes, those machines that display stock prices, fall behind. At one point, they're 4 hours behind. Think about it. You're trying to sell, but you don't even know at what price. You're blind, panicking. At noon, the most powerful bankers on Wall Street meet in emergency. JP Morgan, Chase National Bank, all the big names. They inject millions to stabilize the market. It works. Temporarily. The weekend passes. Investors hope the worst is behind them. Monumental mistake. On Monday, October 28th, the Dow Jones collapses 13% in a single day. The next day, Tuesday, October 29th, Black Tuesday, it loses another 12%. In 2 days, $30 billion disappear. Thousands of investors who had bought on margin receive margin calls. Banks force them to repay immediately. They don't have the money. They have to sell, which drives prices down further, which triggers more margin calls. It's a death spiral. Suicides of ruined investors make headlines. Fortunes built over decades evaporate in days. The 1929 crash won't last just a few weeks. The market will continue to fall until 1932, losing 89% of its total value. It will take 25 years for the Dow Jones to return to its 1929 level. So what can we learn from all this? First, when everyone thinks this time is different, that's exactly the time to be cautious. Second, the warnings are always there. The problem isn't lack of information. It's our ability to ignore what we don't want to hear. Third, leverage is an amplifier. It multiplies gains, but it also multiplies losses. In 1929, it was margins. Today, it's leveraged ETFs, options, crypto leverages. And the most important lesson, greed always looks like intelligence in a rising market. It's only when the tide goes out that you see who's been swimming naked, as Warren Buffett would say.